Hi, everyone. Welcome back to the Real Estate Roller Coaster. My name is Alice Kuder. I'm with Berkshire Hathaway Real Estate in Seattle, and with me is...
Hi, everyone. It's Evie from Guild Mortgage here in Seattle.
Right. And today we are going to talk to you about what we're calling the economics of remodeling. So if you own your own home, or if you're going to buy one that needs some remodeling, we're going to talk a little bit about when does it make sense to do that, and in terms of the value that you're adding to your home. So sort of the general rule of thumb in terms of remodeling to get back your investment is that the kitchen and the bathroom are the two rooms where people tend to value the remodel of that more than other rooms. So for instance, if you were going to obviously remodel either your kitchen or your bathroom, the value of that versus doing something in a bedroom or a basement or even a deck, you are much more likely to get back the full amount of the investment you're putting in. There is a great resource for this called Remodeling Magazine. And if you look in your chat, I've already put a link in there. They every year do a major report they call cost versus value. And it is specific to various parts of the country, including Seattle. And they rate remodeling projects on they both the low end, the medium end, and the high end. And they tell you for each of those how much you are likely to get back if you put them in on various projects. So that's really valuable information, and they get it from very well done surveys every year where they actually, this is actual information they're getting from builders and realtors and contractors. So it's not pie in the sky, you know, we're kind of guessing at things. Very good information. And the report is still free. I'm amazed sometimes that they're able to do that. And as I said, the link is in the chat there. So the other thing I'm going to add in there, though, and I really should look at their report and see if they have added this information lately, but is in energy efficiency upgrades to your home. Those are becoming more and more valuable and more able to help you recoup the cost of your investment, not necessarily on energy savings at the time, but on in increasing the value of your home in the eyes of a potential buyer. For instance, solar panels added to your home so that they no longer have that cost of energy when they get into your home. Those kinds of things can be very valuable and add a lot of equity to your home. So I want to go over to Evie here now for a minute and have her talk to you a little bit about how to refinance various remodeling projects.
Yeah. Well, first of all, I'm really fascinated with that magazine. I had no idea there was something like that out there. So that's a great resource. Thanks so much for that, Alice, because I definitely get these questions as well. There are 3 different ways to finance these projects. And I'm speaking about these as if you already own the home. Okay, so these won't be, as they are available as a purchase as well, but that's a little bit more complicated on how that works. So if you already own the home, there's 3 different ways. There is an FHA has a product called a 203K, and that has some advantages in terms of helping people that might have some credit challenges with their credit score. So, and it also has some loan to value basically a little bit more flexibility. Okay, so then there's the FHA, so I'll go on to the next one. Then there's the Fannie Mae has a Fannie Mae home style loan that's conventional. That one might be a little bit harder to qualify for, but definitely still flexible. You have to have 5% equity. So 5% equity in the home. That's actually including the after and the improved value. Okay, so like your home is worth $350,000, but you're going to do your construction costs are $50,000, and that's going to be a total of, and maybe you have a loan amount that's $300,000. So now your loan amount is going to be $350,000, but it's going to increase the value to $450,000 or $500,000. Okay, so So that's what I mean by after improved value. So it's the appraiser is actually going to appraise the home in the beginning when they're looking at the plans, and all and the bid from the contractor and everything like that. They're going to appraise it for what it would appraise for. If for any reason, somebody, maybe they just recently purchased their home, they didn't put much down, they really have some great plans, they want to add a second bedroom, a second floor, maybe an additional bathroom and bedroom, and yet the after improved in value is not going to leave them with 5% equity, that's when an FHA loan is actually really helpful, comes in helpful, because we can go to 115% loan to value on an FHA 203K loan. So that's where that will have a lot more flexibility. Now there's pros and cons in terms of mortgage insurance and, rates and different things like that. But those two products will help for anything that's a loan amount of 741, 750 or below in King, Snohomish, or Pierce County. If your project is going to take your loan amount to greater than that, then you're going to fall into more of a custom construction loan, or what we call construction to permanent financing, or for short, construction to perm financing. So those lenders that do that usually require it to be a pretty big project. So they're looking at 150 to 250,000 to be able to do that. And then that's sort of since it's sort of like a jumbo loan, it has definitely more requirements, reserve requirements, higher credit score requirements. You'll have to have 20% equity instead of just 5%, but it is available and it is out there. So there's 3 different options there: the FHA 203K, the conventional Fannie Mae home style, and then a custom construction, which is a construction to perm financing.
Okay.
Yeah.
As you're talking about that, well, one thing I'll mention, people might wonder, well, how do I know what my home's going to be worth after I do these renovations? So an appraiser is the official word on that. The lender.
Alice, it looks like you froze for me, so I apologize if you're there. You're back. Okay.
Okay. Okay. So an appraiser is one that the lender will require in order to go through with the financing. But before that, you can ask an agent or agents to give you their estimates of what your home would be worth before and after the renovations. And that's kind of a good starting point, because that's a free service that any agent should and would be willing to provide you. And then that can kind of slip over into working with the lender to make sure that their numbers kind of agree.
Yeah, that's a really good point, Alice, because we don't want them to go down a path where in the end, we won't have enough equity and it doesn't work for them. So those are definitely things that we look at. I forgot to mention the other way is to do maybe a home equity line of credit. So those go to normally all credit unions and banks that are doing that go to 90% combined loan to value. So whatever their first loan is, and then this second proposed home equity line of credit, it can only be usually around 90% of the current value of the home. And that's where sometimes a home equity line of credit falls a little short. So that's the con about it, because you might have these plans that make your after improved value much more, but the home equity line of credit doesn't care about that. It's only looking at your current value. So you might not be able to pull out enough money. That's usually what I experience when I'm talking over the options with clients. Home equity line of credit doesn't seem to give us enough money. So then that's the advantage of going with the construction loans, because we are looking at the after improved value, and that's where we get enough. Because when you're talking with your contractor, building costs are so expensive right now. So everything costs much more than you think it will. And, I have also seen so many of these end up to the point where people have done all the research. They've even gone and got, architectural plans and talked to their contractor, and then end up thinking, you know what, I can buy a home with less hassle that I really want, because I just can't make my current home work for the situation. Maybe it has something to do with the layout of your home. You know, it's just not ever really going to work. So a lot of times we talk about these and we go through all the scenarios, and, you know, I would say more than 50% of the time people end up purchasing another home, but
Mhm.
it's still something, you know, worth looking at. And sometimes what you want to do is a smaller, so you're not adding bedrooms and bathrooms. You're just wanting to, you bought the home and it just needs more upgrading, you know, just like I said, nicer kitchen with nicer countertops, nicer bathrooms, things like that. So those are usually fit really well into the renovation loans, and actually even with a home equity line of credit. And the nice thing about the home equity line of credit too is that it's your money and you get to do your construction how you want to do it. The construction loans, all of them are very highly micromanaged. So it's the bank that's approving it. I mean, you've got to have the plan. The plan is the plan is the plan. So it's like, in case something even happens to the contractor that you're working with, the plan is very solid, very itemized out, very detailed, so that they have to go to another contractor. It's there it is, you know, and here's what was done. This contractor unfortunately went out of business. We need it to be finished. Can you finish it? And here's what's, you know, left in the budget. And lastly too is how the construction loans work is that the money for the renovation project is held with that lender or bank that is doing the construction loans. And the contractor calls out certain phases. So they say, okay, I'm ready for someone to come and approve what we've done so far, and then, you know, cut me a check. And so then the contractor gets a check, you know, and so the money is held in an escrow account for the lender, for the buyers, for the borrower's loan. But that's how that's handled. So the contractor doesn't get all the money up front. It's actually a very safe way to really do it, in a way, because the lender and the bank are vetting out the contractor as well, which sometimes most folks might not do. They might Google somebody, but when a bank is doing it, they are, you know, reaching out to get references. They are reaching out to the vendors, to their vendor, you know, like, are they paying their bills on time? They're doing title searches and lien searches, making sure that the contractor doesn't have liens against them, that they're paying their contractors on time. So you're getting someone that's really been sort of vetted out and is not going to leave you high and dry, take your money and leave you high and dry. So that's the positive about you know, going with a construction loan. It is very safe for the consumer, more so, I feel like.
Mhm. Well, and what's implied there, but I want to just make real clear, is that with a construction loan, you can't do any of your own work. And it can't be Uncle Joe who knows how to do the plumbing or whatever. It does have to be licensed, bonded contractors.
Exactly
So,
like you wanted. And that sometimes that doesn't work for somebody who is, you know, in the business and wants to do it themselves. Then you're looking at home equity line of credit, or maybe even like a cash out refinance. So you've had a home for a while, you've paid your mortgage down, you have some equity. Now you're doing a cash out refinance because maybe you can lower your rate at the same time. That's the only reason why you'd want to do that, if you could lower your rate at the same time and also fix all of that money that you're taking out. Where home equity lines of credit are not really, you know, they're adjustable. They're an adjustable rate and they're an adjustable payment. So some organizations, some credit unions do have the ability to fix them, but they're always at a higher rate than the market rate for a 30-year fixed. So, and you cannot go past, you have to have 20% equity on those cash out refinances. So that again can sometimes limit somebody if they need more money and they have to stop at 80% loan to value.
mhm,
So that's when they'll maybe do a renovation loan.
okay. And I think there's often confusion between, I don't know if we've used the term HELOC, HELOC, which is a home equity line of credit,
Mhm.
versus a home equity loan.
Mhm.
Can you just tell people the difference between those two?
Right. The home equity line of credit is a line of credit. So let's just say that you applied for, and now you have $100,000 line of credit, and your renovation, because you think that that's how much your renovation will cost. What's nice about the line of credit is that you're only paying on what you draw out. So with that money, you're getting your architectural plans, which cost X amount of money. And that might take 3 months, but you're only paying on the $10,000 or $20,000 that you're drawing out. And then next you're, putting down your down payment with your contractor. And so you just draw that out. So you're able to sort of draw it and kind of pay the contractor as you go along and pay for the supplies and only pay on what you draw. The loans themselves are 25 years, and the first 10 years they're interest only and adjustable, but the interest only means that the payments are really small. So it's not a principal and interest payment that you pay. You're only paying the interest only portion of it. So it makes your payment much smaller. You can certainly pay extra. And if you happen to, over the next 5 years, pay that $100,000 down, well, then you're still able to draw on that home equity line of credit. It's like kind of like a credit. I hate to say this. Sometimes I think of it like a credit card against your house. You can draw it down, you can draw it back out. You can draw it, for the first 10 years. After that, they say, no more. We're going to fix this. And whatever, if you have a zero balance, then sorry, you can't draw anymore. That's when people usually redo them so that they can draw on it. And some people don't, maybe they had 50,000 left and they're like, okay, it's going to be fixed. When it's fixed, it's actually over the remaining 15 years. And it's also principal and interest. So the payment will be higher. That's the downside of it. But again, usually, except for in 2007 and 2008, 2009, when we were going down in value, historically, though, it's been relatively easy for folks to redo their home equity line of credit. Home equity loan is where it's going to be fixed. So it's great, but it's not going to be at the current, 2.875% 30-year fix. It's going to be at 5%, 5.5%, 6%. It's going to be much higher, but it's going to be fixed. So you take it all at once. So you're paying, even though your project, what you're doing is you're not really going to even have the contractor work on it for 6 months. You're already paying principal and interest on the whole amount that you draw out. So I don't really see that many people doing the home equity loans unless they really have something that they know that they really need to purchase right away, and they're doing that, and then it's fixed.
It's essentially a second mortgage. Is that right?
Both of them are second mortgages that have a title, that are on title. So they're a lien on the title, and not in a bad way, but they're you have your first loan or lien, and your second, this would be a second loan. Yeah. So sometimes people will pay off their home equity line of credit and they have a zero balance, and they go to do a refinance and want to close it, or they go to sell and they want to close it, and they're like, what's this? And it's like, it's a $150 recording fee, because it really is a loan on their title, and it has to be cleared off, so some people forget about that. They really do. And a lot of times when I talk to people and ask them about their, do they have a second loan, they sometimes even say no, because they think that home equity line of credit is like this credit card attached to their house, but it really is a second loan.
Yeah, I've had that happen with sellers of mine before. When we calculated how much they thought they were going to get from their sale, they didn't realize they had to subtract whatever amount they had out on another, either a HELOC or a home.
Yes, that does happen. They're like, oh yeah.
Yeah, that's not a good surprise.
No.
So I guess the first thing to think about if you're considering remodeling is, are you doing it to increase the equity in your home, the value of your home, or are you doing it for your own personal enjoyment? And second is, is the best way for you to finance that over time so that you're happy with everything you've done. I think that's all I have to say about it today. Do you have anything else to add, Evie, before we say goodbye?
No, but I'm happy to be a resource for anyone and kind of talk over their situation, because every situation's different, and not, some people, the HELOC works for them, the home equity line of credit works for them. Other people, cash out refinance works for them, and other people end up having to do the renovation loans.
Okay. So yes, if you want an opinion on what your house would be worth before and after any renovations you're considering, I would be happy to provide that service complimentary as well.
Yeah.
So thanks everyone for joining us again, and we'll see you next time.
Bye everyone.